In this week's update, US earnings season starts well. Weight of evidence supports higher prices. Washington DC is the greatest risk to markets, and precious metals rise but still in limbo. My name's Garry Davis, and as always, this is general advice only. And please remember to like and subscribe to the video. Right, let's just start with a bit of market perspective. The US earnings season started. We saw reports from most of the big banks. They all beat expectations. Goldman Sachs absolutely killed expectations, and it was a very buoyant 2 days to finish the week. So a bit shaky early in the week, and then Thursday and Friday were very strong. So things looking more positive now than they have been through September. Now, inflation is a real issue. Inflation numbers, particularly in the States, get manipulated to tell the story that the authorities want to tell. But there's no question that inflation is on the rise, but not necessarily to the point that it becomes a problem. And history shows that markets can still advance while there is increasing inflation and increasing interest rates as well. So my view is that despite a lot of the noise that's out there about how inflation is going to bring the market down and it's going to crash and all these things that I'm sure you're reading, I think the multiples, when you look at them factually rather than starting from a bias point, people that want to talk the market down, use things like the Cape-Shiller index that looks at the last 10 years of earnings growth and concludes that the market is expensive. Well, of course it's expensive if you're looking back over the last 10 years. It's the most ridiculous comparison I've ever seen. So if you're dealing with growth companies that are continuing to grow, then the last 10 years has got nothing to do with anything. So if you look at the facts objectively, without a bias, the current environment is okay, even for the Googles and the Microsofts and the Amazons, given where interest rates are, given where earnings growth is, and given the outlook, multiples are not expensive. So therefore, I conclude there is absolutely no reason why the market cannot continue higher from here. Now, the other reality is that even if inflation does really start to crank up and become an issue, and I think it's sitting at about 5.4% in the US at the moment, even if inflation continues to rise, central banks, particularly the Fed, are convinced it's transitory, or at least that's what they're saying publicly, and therefore they're unlikely to move ahead of the curve like they normally do by raising interest rates. The other part of it is that given the debt servicing levels where they sit at the moment, if they start jacking up interest rates above 3% to cool inflation, the debt servicing costs just go through the roof. So I don't believe that central banks can do that. They're going to have to pull a lot of other levers first, and that means that interest rates are quite possibly not going to be rising next year or even the year after. So that's just the reality. Now, markets are periodically going to get worried about the inflation numbers, but it's really hard to see it triggering a significant correction. It really is. And this is a really important point because, if you read material from the mainstream sources, it's going to frighten you from time to time, because that's the story they want to tell. Bad news sells. So you just need to remember, this little bit that I'm doing here, that it's incredibly unlikely that we're going to see very much of an interest rate rise in the next probably 2 to 3 years, if any. And that's just the reality. And if that's the case, then there's no reason why good growth stocks can't continue to move higher. The other part of what the Fed is talking about, of course, is tapering, and that's reducing their bond buying, the amount of stimulus that's going into the system. And they'll quite possibly start tapering maybe in December. But they'll talk about it first and then give the market adequate warning. So they may well announce in November that they're going to start tapering and actually start doing it in December. But you can rest assured that at the first sign of trouble in the market, that tapering is going to disappear. They're going to stop it. So therefore, the overall environment, I think, still looks pretty good. Now, we're still going to get volatility. The market's still going to get frightened from time to time. There's all sorts of triggers out there that could do that. But that's just going to be short-term noise, like we saw in September, where the market went down, the index went down 5%. But it's really hard to see anything much more than that. And as far as a 10 to 20% correction goes, it's just really quite unlikely unless something quite untoward comes on the horizon. And look, there are some things out there. It could be China could make a move on Taiwan to, distract from the domestic problems. Something like that is a left field issue. But putting that aside, it's pretty hard to not see the market continue advancing through the rest of this year and into 2022. But albeit with volatility. So I don't think it'll be plain sailing. Let's look at American stocks now. The S&P was up 1.8% for the week, but had a very strong finish and is only 1.5% off its all-time highs. So it's been quite a quick turnaround. And the really interesting things about what happened on Thursday and Friday is that the defensive sectors, utilities, consumer staples, were the worst performers. And, that's what you want to see in a bull market. You don't want to see money going into the defensive sectors. We saw some of that during September. But there was quite a concerted move back again, and we'll look at some of those charts. The banks' reports were good. Banks were solid. Goldman Sachs absolutely killed it, finishing their earnings were about 50% above the estimate, and the estimate was obviously showed an increase in earnings. So, that's an amazing beat when you think one of the world's biggest banks can beat the analyst estimates that are, they're all over it like a cheap suit, and yet it still was able to come in 50% above that. We also saw some strong rotation into the consumer discretionary area. That's another excellent indicator of a pretty buoyant market. So things looking very positive again in the US. Now the US dollar eased a little bit to 93.94. The 10-year yield also came down a little bit. It got up above 1.6 at one stage. And the VIX has now dropped back down into the mid-teens again. So let's take a look at some charts. We'll start with the S&P, and you can see this correction that we had. Wouldn't even call it a correction, really. It's just a pullback. During September, it amounted to about 5% at the most, and we've almost got back to the all-time highs. So that's pretty impressive. Now, if we look at the key spreads, so this is, I think, one of the most important ones. It's consumer discretionary divided by consumer staples. When the line is rising, the ratio line is rising, then consumer discretionary stocks are doing better. You can see from the March crash of 2020, we had a very, very powerful outperformance by consumer discretionary stocks. That peaked out in January. We then went sideways. But we've been at the elevated levels of that range for some time, and now we've finally broken out. So things looking very positive from that perspective. Let me just go to, this is the Russell 1000 growth divided by value. So whilst this hasn't broken out yet, you can see in the last few days since earnings season started, the growth stocks are starting to point upwards again. And if we look at the growth small cap versus the value small cap, not quite as pronounced, but still we are in we're back into a short-term uptrend on that ratio as well. Now, there's just a couple of other sector charts that I want to show. The first is, this is the consumer discretionary. So we saw the ratio against consumer staples rising But in absolute terms, we've now got a breakout on consumer discretionary. So whichever way you slice it, this is a sign of a very positive market. And look at the volumes that accompanied that breakout. Really quite good volumes. Let's look at finance. So finance sector managed to break out on Friday on the strength of that Goldman Sachs number. This is energy. Energy, of course, has done extremely well, and we've now broken out in energy, and I'll have more to say on that when we get to the oil sector. And this is URA, which has had a terrific run. Now, to me, this sets up extremely well because we broke out with a lot of momentum, but then we pulled back very sharply, and a lot of people got concerned about the strength of that pullback. Went sideways for a few days around about that breakout level, and then when uranium prices really took off, I think went from about $43 a pound to about $50 a pound, pretty much overnight, we saw this huge surge on Tuesday and Wednesday, setting a new 7-year high. But then, and look at the volumes around that, volumes really strong. But then we get a little consolidation, which is fine. And honestly, I'd rather see that than the price just continue to rocket up. This is healthy. Look at the volumes. The volumes came off quite sharply, and the prices closed well off their lows on both days. So to me, this is a very positive setup for uranium. And perhaps for a lot of traders and investors, going into the uranium space through an ETF is maybe just a smarter way to do it than trying to pick individual stocks, because there's still a lot of things that have a lot of regulatory hurdles that have got to be jumped through for most uranium stocks to either start production or get back into production. And the final one that I want to show, and again, this is really important from an overall indicator point of view. This is the transportation index. Now, the market is rarely doing well if transports are not at least performing reasonably. Now, transports peaked out in May and then had quite a protracted down and then sideways momentum that took it just below the 200-day moving average. But you can see just in the last week that we've actually seen transportation stocks start to turn up relative to the S&P. So things looking quite positive there for transports. Now, if we look at the currencies, this is the US dollar. So it had a crack at a breakout. We're just doing a little consolidation at the moment. Hasn't changed trend, so we're still basically in limbo with the US dollar. But you've got to say that the balance of probability is that the US dollar breaks out and heads higher from here. And a big determinant about that will be what happens in Europe. What happens with the euro will really determine the short-term direction and the medium-term direction of the US dollar. Now, if we look at the Aussie dollar, you can see we've bounced up quite sharply, actually. We've bounced up more sharply than what the US dollar went down or consolidated. And I guess that's largely around the improvement in commodity prices. So iron ore did manage to bounce back up, and as we'll see shortly, there was very significant moves in other commodities, in energy, in base metals, etc. All right, moving on to the Australian market, 73.68 is where we finished. Our market, our index was up 0.6, but one would think there'll be probably a move higher on Monday. Material stocks rebounding, and IT stocks were the driving standout forces in the Australian market. And copper was especially strong, and copper looked really good on Friday night. So we can expect copper and nickel stocks to do well in Australia on Monday. Let's take a quick look at those. So there is the ASX 200, really just consolidating sideways above the 200-day. Just while I'm here, I'll just mention Bitcoin. So for those that are tracking Bitcoin, we had all-time highs up here around 64,500 back in April. We then looked like it was breaking down. We had short term, we had lower highs, lower lows. Looked awful. Looked like 20,000 was going to come into play, but then it's just all turned around again. And we've had this massive surge, despite what China is doing with Bitcoin and the crackdown. I believe there are some reports in America that there could be an approval for a cryptocurrency ETF, and that certainly got things fired up on Friday night. And Bitcoin finished at 61,500. But let's look at gold and silver. We'll start with gold on the daily basis. You can see we had a very strong move on Wednesday. Took it up to 1780, but then we gave a lot of it back on Friday as it turned back down again. Now, so if we look at it on a weekly, we're still in this declining channel, so, and we haven't taken out these highs here either. So whilst it was quite a robust move, when you look at that, we're still in this overall channel. So the best I can say about gold at the moment is that it's in limbo. And this is silver. And if we look at a couple of the spreads, we'll see that, and this is, I guess, a little bit positive. We'll see this is gold stocks against gold. So generally gold stocks will lead. So you really need to see this line kicking up, which is what it did towards the end of the week. Now, it's still in this overall consolidation, so that doesn't really prove anything at this stage. But at least in the very short term, it's a move in the right direction. It's at least it's a little flag that maybe things are changing. And also the fact that this line was rising. So this is gold divided by silver. Line rising means gold's outperforming. Line falling means silver is outperforming. And again, that just started happening towards the end of the week. So a couple of positives there. Silver doing better than gold. Gold stocks doing better than gold. It's not enough yet, but it's a bit of a light at the end of the tunnel, perhaps. So just to summarise, gold finished up $11 to $17.68. There are just numerous bullish factors. I mean, rising inflation, negative real interest rates. You can't get a much better environment for gold than that. Okay, the US dollar is going up. That doesn't help, but the US dollar is only one of 5 or 6 factors that determine where gold's going to go. So it's a pretty bullish environment, and gold is still struggling. When we look at the stocks, GDX, it's moved back to the top of the range, but it hasn't broken out yet. So let's look at those charts. So we've come back into the range, we broke down, did a little retest, went on with it, but we still haven't managed to break out as yet. So we're in limbo. No, requires confirmation is where we're at. But look, I must say there's some increasing volumes on the up, and I'm pretty open-minded about the precious metals sector at the moment. There's a few better looking signs, but we're not there yet. Now, turning to other commodities, copper and nickel absolutely rocketed up, particularly copper shot up to $4.71. Nickel went up to $9.08. And what we've seen over the last handful of weeks is, I think, the aberration with those prices. And I think what happened on Thursday and Friday has really just restored the former trends in those base metals. Now, crude oil is still going up, finished at $83. And perversely, what's happening here is that the focus on green, on renewables, on hydrogen, that's just absolutely dominated the media in the last few weeks. What that is going to do is virtually assure that we're going to get further underinvestment in oil and gas. Now, a lot of people will cheer and say, yeah, well, that's fantastic. That's what we want to achieve. But what that does is it really locks in high prices for oil and hence feeds into inflation. So there's actually there's a whole bigger picture at play here. And the reality, as particularly someone as green as Elon Musk has pointed out, that to get mass adoption of electric vehicles will require a huge increase in electricity production. And then that begs the question, well, what's going to produce it? Renewable energy is struggling to gain market share over coal and oil at the current levels. And if electricity generation for mass adoption of EVs has got to go up significantly, then how the heck are they going to bring that amount of renewable energy on quickly? So I think this whole transition from fossil fuels to renewables is going to take a lot longer than I think what people are thinking about, and all of the infrastructure that goes with it. You're not going to be able to get mass adoption of electric vehicles until you've got all the infrastructure in place, the charging stations and the capacity to generate electricity at the time that everyone wants to charge their batteries. So I think all of that virtually assures that we're going to see high crude oil prices for some time. And as I indicated before, the uranium setup looks great. And also on lithium, we've seen strong continued rises in lithium in the last few days as well. So the outlook for commodities really remains very strong. There's the 1 year on spot copper, you can see, so it's really shot up again and challenging the all-time highs. And there's copper inventories. So we've come off a bit from around 260,000 tonnes in the London Metal Exchange down to about 190. That's a pretty concerted drop. And I guess that is certainly part of the reason for what's happened with copper. And nickel, something similar. We're back to the highs that we saw a few weeks ago. So wrapping everything up, it's just another reminder to ignore the analysts. And you might remember this a couple of weeks ago because it got a lot of media coverage. The headline was, and this is direct quote, "The 6 largest Wall Street banks issue a market red alert," and it was widely reported everywhere, even on commercial news channels. And the story that went with that is that a 10 to 20% correction is coming. So that was the headline, and I'm sure that influenced a lot of people to get out of the market. But the reality, of course, is something completely different. We saw a quite mild 5% move down, and now we're back within 1.5% of the all-time highs. So my point here is take notice of this rubbish at your peril. And it's easy to be drawn into it because you think it's authoritative, but most of the time it's just misleading, significantly misleading. Portfolio analysts last week, we looked at technology and cybersecurity stocks. There was also another new addition to the portfolio that I'm pretty excited about. And that's it for this week. If you want more information, it's on the website, and there's my email address for anyone that wants to contact me. So I think we can look forward to probably a pretty good start to the week in Australia. This was options expiry in the US. That always creates some unusual price movements, to say the least. So, we might see a few strange things happen in the first few days of next week. But look, that's all just short-term noise, just, to be ignored. But the signs at the moment are pretty positive for the run into Christmas. I'll be back with you next weekend. Cheers.